every once in a while, the Barron's newspaper lists a stock, or they pick a stock that they feel is a buying opportunity right now. And I often cover them on this channel, but I don't just cover them at a surface level. I build out a full model and I look at the options opportunities that are available on that particular stock. The stock that they just highlighted was American Eagle. So it's very interesting to me because I got that Peter Lynch approach, which is look for simple businesses that are easy to understand. And this is definitely one of those. So I'm going to fully break down what they're saying and what I'm seeing in the models and in the options opportunities. So that's what we're going to be covering in this video today. You're watching More Money. Let's get it. What's up, guys? And let's get right into this one. So American Eagle, obviously, just like any other retailer, it's been beaten up really bad as of late. How bad, do you ask? Well, you can see that over the last year, the shares are down approximately 63%. And because I batch record these videos just so that I can get a video out to you guys every day, by the time that this video comes out, it might actually be even down even further because I expect more pain ahead for the retail sector in this year. And you can see this is the article that I'm talking about. Barron said on August 14th that American Eagle stock just got smacked in the retail carnage, but we should be buying the dip. So the immediate questions that I would have is, what does the company think about the share price decline, and why is it an unwarranted decline, which would cause this to be an opportunity in the eyes of Barron's? Well, the answers to those questions are right here early in the article. So they did say that the valuation of the company has been impacted by the fact that the retailer has been experiencing higher freight costs and excess inventory amid slagging consumer demand. That is not unusual to what other retailers have been experiencing. You guys already know Target has fessed up about having excess inventory. So has Walmart. So has Abercrombie and Fitch. We've covered all of those on this channel. And it goes to a larger theme of a video that I'll link at the end of Michael Burry coming out and saying that we're going to potentially have a bullwhip effect that we're going to see on the retail market. And that's kind of what we're seeing right now. But in the article, they're saying that the stock does have believers who believe in this company over the long term. So Jefferies analyst Corey Tarlow has a buy rating on the stock and a $27 price target. But what exactly is he saying? Well, he's saying that the buy side has all of the downside baked in terms of the bad news. And he expects the company to be in a somewhat better position by the holidays. And I think what he's getting at is he might have actually seen my closet, and all of the jeans are from American Eagle, and all of them are ripped in one way or another. And so I need to replenish my closet. So I think what he's suggesting is that Tay is going to go to American Eagle before the holidays, and by all the massive purchasing of jeans that I'm going to do is going to bring the stock right back up. No, but really, what exactly are they seeing? Well, they're suggesting that American Eagle looks well placed for future gains, particularly from its fast-growing Aerie division. And the Aerie brand continues to take market share. Note that it was launched in 2006. And at the time, it had less than 5% of total sales in that sort of intimates line. Now, the company is the number 3 retailer in that category behind Victoria's Secret and Hanes. And I just don't think anyone's catching up to Hanes because they sell at Walmart. How can you beat Walmart? And it can't just be that their fast-growing Aerie brand is what's going to bring them back in this environment. It looks like it also comes down to how they've been performing with their online brand. You can see that the Barron's article suggested that American Eagle's online business has been expanding. It generated 36% of its overall revenue in 2021 from its online business, which was up from 29% in the year before the pandemic. And the company said that they're going to use all of their cash flow that they're generating from these solid results to buy back approximately $200 million of stock. And it looks like even analysts who have downgraded the stock say that it could do well in the long run. So it looks like all of the pessimism being baked into the current share price is a result of near-term headwinds. But remember what Warren Buffett always says, and I'm kind of paraphrasing it here, but effectively says something along the lines of, if you wait to see light at the end of the tunnel, you're already too late. And the way I look at this business is it's going to be around for the long term. They are a good retailer. They have a strong product. I love their stretchy jeans. And so what does management think of the business overall? Now, at least for 2022, management expects operating profits to be above the $314 million level that they achieved pre-pandemic, with total revenue up in the low single digits compared to fiscal year 2021. So the fact that they're not going backwards on their top line in this environment is pretty exceptional. But of course, guys, you have to note that just because they're not going back on their top line doesn't necessarily mean that they have higher COGS because they're putting their inventory on sale to just get rid of it. And they have higher SG&A costs because they're paying higher wages for the staff that are in their stores. So it doesn't necessarily mean that earnings per share is not coming down. Now, although the company is not providing their longer term outlook, that's not a problem because I have a full model on the company and I can provide what I believe is sort of like their medium to long term outlook and a full valuation. And you can see from my valuation that I am increasing their fiscal year 2023 earnings by around 3%, and I'm just taking 3% throughout. I have reduced their gross profit margins because I am suggesting that the margins are not going to be as strong as they were in their fiscal year 2022. So I brought that back down to their 2020 and 2019 average margin of approximately 35%, that area. So it's the low end of that, but it's that area. But what exactly does the valuation look like? But guys, before I get into the valuation, just note that 80% of the watch time on this channel comes from people that are not subscribed. So if you have a second, hit that subscribe button so that you don't miss out on more great content. Now let's go right into the valuation. So I do believe that a terminal multiple of 15 times is more than good. In fact, I would argue that a terminal multiple of 12.5 times is probably better, but let's just use 15 times for now. And I believe that this company is worth around $16 per share. It's currently trading at $11.80. So its share price as a percentage of its intrinsic value is 73%. So overall, I don't believe that the stock is necessarily cheap, even with a high multiple. But that's not the end of the story there. If you are looking to get exposure to a retailer, this is not a bad one. And so I always like to look at cash secured put opportunities to see if there's a potential opportunity there for you. And to save you time from looking into it, I actually did the work and the math for you. And so you can see here are the January 19, 2024 cash secured puts. So the $10 cash secured put is yielding approximately 15%. And so with my valuation of $16 per share, the $10 cash secured put with a $2 per share premium reflects a net purchase price of $8. So if you are exercised on this cash secured put, you are essentially purchasing it at $8 a share net, which is effectively 50% of my valuation. And like I said before, it reflects an annualized yield of 15%. So that's not a bad place to be. Now, if you want access to the model that the Patreons do have access to for American Eagle to see how I value this company out at the most granular level, well, you can get access to this model at the lower tier of the Patreons. And if you want to join us for an epic live presentation every month where I reserve my very best work for, you can join us at the upper tier of the Patreons. Now, clothing retail is not the only retailer that I've been looking at. I actually recently launched a video on a specialty retailer by the name of Build-A-Bear. And if you are looking to get retail exposure into your portfolio, you might want to take a look at Build-A-Bear. I investigate if it's potentially a multi-bagger stock, and you can get to that video right here.